Hello, this is Oba Vincent, and welcome back to Financial Freedom for the Average Person. And today we're going to do exercise number 19 on stock investing, and we'll show you how you can do this. So, this is the exercise taken from the book. First, I want you to visit, and I picked three of them here: Fidelity, TD Ameritrade, and Yahoo Finance. Then pick one of those sites, whichever one you feel comfortable, set up an account. All three of them will let you track your stocks for free. And there's a whole lot of other places that'll do it too. Robinhood's pretty popular too. Then take out a sheet of paper and write down 10 companies or products you're familiar with and research each of them to determine if they're public companies and if they're making money. At this point, don't waste your time with any company that you don't know and is not profitable. Okay, so later on, you may want to get into that. If it doesn't make money, don't go for it. So then on one of these websites, create a portfolio or watch list, whatever they call it, and list the companies you identified. We're going to write down the current price of the stock and the date you identified it. Some sites will do that automatically. Each one's a little different. Then evaluate stock. What was this 52-week high and low? What is this dividend? When does it go ex dividend? What do analysts think? And what's its target price? And then you can even ask an AI bot what they think about it. Then we're going to watch the stocks for at least 10 days, see how they move up and down. Then I would say pick one or two of these and create a fake portfolio. Basically, pretend that you have bought 100 shares of each of them at the current price and watch what happens over a week. Now, I also say several of the sites that I've got listed there, Fidelity, TD Ameritrade, they will actually let you do a mock portfolio where you can actually just practice trading, practice buying, things of that with fake money. So it's another good way to learn. And if you're happy with the performance of some stocks you have selected, select a stock and buy some shares. I like 100 shares or $1,000 worth to start. Uh, and you have to have an open brokerage account. Follow the stuff that I talked to you before about getting a brokerage account, trying to get paid for it, make sure they're giving you interest on your money. Okay. So in the book, I took what I did for exercise 19. And what's interesting is this was done back in January of 18. So it was done 8.5 years ago. And if you look at the companies that I put in there at that time, we had Apple, Amazon, Coke, Kohl's, Bank of America, Facebook, Ford, Snapfish, AMC, and ExxonMobil. And you can see the prices and you can see what the earnings, what their dividends were, ex-dividend. I put their highs and their lows, and what their one-year targets were. And then I kind of made some guesses what I might invest in and what I wouldn't. Now it's interesting. So I did this 8.5 years ago. So I put the prices here in the bottom. I went back and I looked at what they were on August 7th of 2026. And you can see some of them did extremely well. Okay. Uh, Apple doubled. Amazon actually did a 20-for-1 split, and based on that, it's up like 5 times, 4 times. Um, Coke did well. Kohl's, unfortunately, which I am invested in, did miserably over the last 8.5 years. Bank of America doubled. Facebook went through the roof. Snap got cut in half or more. And AMC got destroyed. And ExxonMobil basically doubled. So I did, it's like, what if we just bought one share of each back then? And I calculated that would actually have generated a 40% return. The big thing, it's annualized return, but the big thing is really things like Amazon and some of these that really went up big time. That, kind of overweighed things. So I did another way. If I was to put $1,000 in each of the companies, so it'd been 10,000, you'd made 7.5% return. It's not bad. Now, I will say if you just bought the index fund and put in the S&P 500, over that period of time, it annualized return was 14%. So, actuality, stock picking, if you pick the right stocks, can be amazing. If you don't, it's still not bad, or it could be really bad, like I picked Kohl's. But the S&P 500, you 12% is the return that I'm always looking for, and that gave you 14 over 8.5 years. So that goes a long way into making your investments go up. Now, I've used this slide before, but we're taking a look here at what stocks that you could get. Okay, what brokerage accounts, and I went and I poked a couple of these, and I looked for something that wouldn't cost much. And I mentioned before, SoFi is good for banking. It's also good for the brokerage, and they're kind of up and coming. And they have a little interesting offer, but you always will find offers from this. And I'm not promoting SoFi, but again, I am promoting getting paid to move money into anything. And in this case, SoFi, if you just open an account with 50 bucks, they will give you a random stock that's worth between $5,000 and $3,000. And based on how much money you put in, more money you put in, you get more of those stocks. And it's a little claw game where you're actually reaching with a little claw and you pull them up. So anyway, but there's things like that out there. There's lots of them. Get paid to do it. Okay. Next, I did want to just talk a little bit about how do you actually buy a stock? Well, I went to Ally, so I have an account at Ally, and a lot of the accounts now, everything is on apps, and I want to like still pull it right off the web. So I went to Ally, and I just have a little bit of money in Ally right now, like $100 or something. So I picked a stock. In this case, I picked AT&T because I have a lot of AT&T, and I said, okay, I'm gonna buy it. So I'm gonna buy it, and then I'm going to buy one share. And you can see here now you pick if you're going how you're going to buy it. You can buy it at market, and that's okay if the market's open and there are it's a company that trades a lot of shares. AT&T trades a lot of shares, so it's fine to do it at the market. But almost always recommend do a limit. And when you're doing a limit, it means that you're going to buy it. This is my price. I'm going to buy it for. And if it is above that price, it won't trade. It won't happen. It won't, go through. And then I picked it as duration. You can pick day, or you can pick good to canceled, which is I did here to GTC. So it's all ready to go. All I have to do is preview the order and place it. And then, and this is just going for during the market hours. So it would sit and it would wait until the market opened, and then it would execute it probably because these bounce around a few pennies. But however, if it opened up, I guess if it opened above my limit price, it would not execute. You know, and then I would go in and I could change it. Now, in the fees for doing this, absolutely no fees. So most of the major brokers anymore are free. It used to cost almost $10 a trade, so it was expensive back then. But everyone got out of that. And anyway, so that's a little bit on stock investing. I hope it inspires you. I hope that you follow the exercise and give it a shot. Thank you very much, and we'll be back with the next exercise.